What if I told you the money in your bank account doesn't actually exist? No, seriously. What if every dollar you've ever worked for, saved, or trusted your future on was built on a promise that can never be kept? You think you own your money, but what if the system owns you? Because here's the truth. Every single time you swipe your card, take a loan, or check your balance, you're not just participating in the system, you're feeding it. And the craziest part, this isn't a bug. It's how the system was designed to control you from the very beginning.
In this video, you're going to finally understand how banks create money out of thin air, why your savings are just numbers on a screen, and how the entire economy depends on you staying in debt. You're about to see how a 600-year-old trick, started by medieval goldsmiths, became the foundation of modern banking, and why every crisis, every bubble, and every bailout is just the same magic trick repeated on a global scale. So before you spend another dollar, before you trust another bank statement, watch this video till the end. Because if you don't understand this, you'll keep playing a game where the house always wins. Let's break the illusion. Let's start. The core illusion of money. The funds in your bank account don't actually exist. This isn't a figure of speech, nor is it mere conspiracy theory. If every customer decided to withdraw their money from the bank tomorrow, the system would fail within hours, because the cash simply isn't present. This is neither a coincidence nor a malfunction. It's the structure of the worldwide financial system, a deception so ancient and so integrated that we've come to view it as normal. This concept is known as fractional banking, and it serves as the silent force behind global debt, inflation, and the illusion of wealth. Once you understand its mechanics, you'll come to realize that money itself is founded on promises that can never genuinely be fulfilled. The historical origins of the trick, the goldsmiths, and the birth of receipts. To grasp how this all started, we need to go back to an era before our society operated on digital apps. In medieval Europe, people used gold and silver as currency. If you were affluent, you possessed coins stored in a chest or valuable gems for trading. However, transporting bags of gold was risky. Consequently, individuals began entrusting their valuables to goldsmiths, individuals with secure safes. In return, the goldsmith would provide a receipt, a straightforward document assuring the holder could come back and retrieve their gold. Before long, people realized they could exchange these receipts in place of the physical gold. After all, the note held the same value and was much easier to carry. The birth of fractional lending. This is where the trick originated. The goldsmiths observed a curious trend. Nearly no customers came to retrieve their gold simultaneously. Out of 100 customers with deposits, perhaps only 1 or 2 would actually appear to make a withdrawal on any given day. This meant that the majority of the gold remained untouched. So, the goldsmiths became inventive. They started to issue more receipts than the actual gold they possessed. If they actually had 1,000 coins, they might issue 2,000 receipts. They could lend out those additional receipts for interest, profiting from gold that didn't exist. As long as everyone didn't demand their coins all at once, no one realized it. Essentially, it was money created from nothing. Institutionalizing the trick. This wasn't merely a convenient side venture, it was transformative. Once society accepted paper claims as equivalent to gold, the creation of money became liberated from tangible constraints. This practice gave rise to banks, which institutionalized the concept. By the 17th century, even governments began to adopt it. The Bank of England was established in 1694, not for the benefit of the public, but to address a crisis. The crown was overwhelmed by debt from ongoing wars. The bank provided loans to the government, significantly exceeding its actual reserves in return for interest payments. The debt was settled not through treasure from new victories, but through taxes levied on ordinary citizens. Does this sound familiar? That's because it's the same strategy governments employ today. Borrowing funds that aren't real and then imposing taxes on future generations to fulfill the obligations. The American path and the rise of central banks. The United States followed a similar trajectory. Early American financial institutions issued banknotes that could be exchanged for gold, but they soon realized they could produce more notes than they had gold reserves to support. Occasional bank runs revealed the reality. Frantic depositors clamoring for their funds, only to find that the money wasn't actually available. Entire financial institutions failed in the blink of an eye. However, rather than eliminating this system, governments opted to reinforce it. They established central banks to provide a safety net for this illusion. The message was unmistakable. Even if the money isn't real, we'll ensure the public continues to believe it is.
How the modern system works. The 10% reserve myth. Now, let's break this down in today's terms. Because fractional banking is so abstract, it can feel like smoke. Imagine you walk into a bank and deposit $100. You think that money is sitting safely in your account waiting for you. In reality, the bank is only required to keep a tiny slice of it in reserve. In the past, that fraction might have been 10%, meaning the bank would keep 10 and lend out 90. Maybe someone borrows it to buy groceries, and the shopkeeper deposits that 90 into another bank. That bank keeps 9 and loans out 81. That money gets deposited again, loaned again, and so on. By the time the cycle finishes, your original $100 has multiplied into nearly $1,000 circulating in the economy. But here's the catch. Only the first 10 actually exists as cash. The rest is debt. Every new dollar in the system is born as someone's obligation to pay it back with interest. The zero reserve reality. If that surprised you, I have some unfortunate information. What I just shared is already a dated narrative. Currently in the United States, reserve requirements aren't set at 10%. They stand at 0. Since March 2020, the Federal Reserve has mandated that banks hold absolutely nothing, not a single dollar, in reserve against the deposits they accept. This means that the tidy little multiplier no longer governs how banks extend loans. The real constraint. The Basel rules. If banks aren't required to keep reserves, what prevents them from lending endlessly? The real limitation today isn't reserve requirements, it's capital and liquidity regulations defined by a global framework known as Basel. The Basel regulations were established in response to a series of financial crises, particularly the one in 2008, by a coalition of central bankers and regulators who convene in Basel, Switzerland, at the Bank for International Settlements, often referred to as the Central Bank of Central Banks. These rules are not formulated by elected officials, but by appointed experts. Here's how it operates. Banks must demonstrate they possess enough equity capital to cover potential losses. While the regulations can be complex, picture this. If a bank intends to issue a risky $100 loan, it might need to retain $8 of its own funds, shareholder equity, as a safeguard. This represents the true limitation. The riskier the assets a bank acquires, the greater the capital it is required to maintain. Additionally, banks must show that they have sufficient liquid assets to endure a short-term crisis, such as cash, government bonds, and other assets that can be rapidly converted to cash. These regulations are designed to prevent banks from taking excessive risks. Loans create deposits. However, observe the shift. Banks no longer lend based on deposits. Instead, they generate loans first, which subsequently create deposits. When you obtain a mortgage, the bank isn't withdrawing cash from its reserves. It digitally adds new money to your account. That new money only exists because you have committed to repaying it. Afterwards, the bank verifies whether it has sufficient capital to manage the risk. This is why in today's financial system, over 90% of the money available is not central bank money, which refers to cash or reserves, but bank money, conjured out of nothing the moment loans are made. Consider this. The funds in your checking account differ from the money produced by the Federal Reserve. They represent money created by banks, originating as debt. This is the reason the money supply continues to grow as long as banks find potential borrowers. Consequently, every financial crisis stems from a breakdown in confidence. When borrowers are unable to fulfill their repayments, or when banks cannot refinance their debts, the entire system begins to collapse. The unavoidable consequences. This framework leads to 3 inevitable outcomes. First, inflation occurs. As banks continue to generate credit from the same dollars, the worth of each dollar diminishes. Prices increase not only due to supply and demand factors, but also because the currency itself becomes less valuable. Second, there is an ongoing cycle of debt. Since money is created through loans, there is always a greater amount of debt in the system compared to the money available to repay it. Interest guarantees that the financial records never balance. Someone is always required to default, refinance, or take on additional borrowing. Third, there is an aggregation of power.
Banks earn interest on funds they never actually possessed. Governments utilize this framework to fund military operations, social programs, and bailouts without directly increasing taxes. Meanwhile, the wealthy, who possess tangible assets like real estate, stocks, and commodities, gain from inflation as it drives up asset valuations, while the average workers experience a decline in their wages' purchasing power. When the illusion cracks, historical crises. When this system falters, the facade shatters. Consider the Great Depression. In 1929, banks had excessively lent beyond their holdings, fueling a stock market extravagance. When fear set in, depositors rushed to withdraw their funds. However, the cash wasn't available. Thousands of banks failed. The same scenario unfolded in 2008. Banks had escalated credit through mortgage-backed securities, crafting a housing bubble based on the same idea: more commitments than actual value. When defaults began to escalate, the entire system nearly collapsed. Once again, governments and central banks intervened, injecting trillions into the system to sustain the illusion. They rescued the deception, as without it, the contemporary economy cannot operate.
The global picture. And this is where the global context is significant. In the United States, reserves have been depleted. In Europe, as well as in the United Kingdom, Canada, and Australia, reserve requirements have become largely symbolic or non-existent. They now depend on the Basel regulations. Conversely, in emerging markets like China, India, and Brazil, reserve requirements are still in place, frequently in double digits, and are actively utilized to manage lending growth. However, even in these countries, Basel capital regulations apply, influencing how much risk banks can officially undertake. Regardless of your location, the constraints on money creation are not determined by deposits held in a vault. They are dictated by regulations established in Basel, Switzerland. The system's dependence on your debt. Here's the harsh reality. The system relies on you remaining in debt. If all households settled their debts immediately, the money supply would implode. Banks would lack funds to lend out. Economies would come to a standstill. The facade relies on your involvement, your readiness to borrow, spend, and accept that the numbers in your account signify something tangible. You serve as both the energy and the guarantor. Conclusion: understanding the game. That's why understanding history is crucial in this context. The same techniques that medieval goldsmiths used to generate profit have been expanded into the core of contemporary finance. The same risks still linger. Bank runs in the 1800s, the Great Depression of the 1900s, and the global financial crisis of the 2000s all serve as reminders that when trust falters, the entire structure collapses. Yet each time, the reaction is consistent. Reinforce the illusion, patch the breaches, and proceed as though nothing transpired. So what should you derive from this? First, money does not equate to wealth. True wealth comprises land, resources, abilities, knowledge, and autonomy. It consists of assets that retain value when monetary promises fail. Second, debt is not neutral. It functions as the lifeblood of a system that favors lenders, governments, and asset holders at your cost. Third, inflation is not a coincidence. It is woven into the framework. Every year, you're expected to exert more effort just to maintain your current position. Does this imply that doom is unavoidable? Not necessarily. However, it does suggest that you need to reassess your relationship with money. Simply saving cash in a bank won't offer protection. Blindly placing your trust in the system won't liberate you. Creating genuine wealth, assets that endure outside the realms of inflation and debt, is the only route to financial independence. The point isn't paranoia, it's understanding. If your money originates as someone else's debt, your freedom hinges on stepping away from that mechanism. History doesn't repeat itself, but it does reflect similar patterns. The goldsmiths of medieval Europe, the banking crises of the 1800s, the housing market crash of 2008, all resonate with the same narrative. A trick that inflates promises beyond what is real, and a public that continues to believe until disbelief becomes inevitable. And let's be clear, this narrative is still ongoing. Every significant financial crisis we've encountered serves as a reminder that the system's stability relies not on gold or productivity, but on confidence. And confidence is the simplest thing to lose. So the next time you check your bank account, remember, most of its contents exist only on paper, created by a debt system that was never intended to serve your freedom. Grasp the trick, and you can start to shield yourself from it. Overlook it, and you remain just another participant in a game where the house always prevails. If this provided you with a fresh viewpoint, consider subscribing. History holds the answers, and I'll guide you on where to find them.